Welcome everyone to this reporting webinar session today. I'm Yvette Lang and I'm a member of the Knowledge and Technical team at A4S. And we're glad to have you on the webinar today, and there's a lot to cover because there's so much happening in the reporting space, but we'll get to that in a moment. We are going to be recording the webinar for others, and it'll also be made available on the A4S YouTube channel afterwards for others or for your reference. So we're going to use the chat box. So if you do have any questions or comments that you have, please do put those there. And as we go over the course of the hour, we'll do our best to get to all those questions as part of our discussions. Please do engage as you need. So what are we going to do today? So we're having a look at reporting. And as I mentioned, a lot of change in this space. So what we want to really leave you with is, what are the benefits of these reporting standards and frameworks? How do they add value? How do they assist in the process? What are the appropriate tools and knowledge that you might need to be aware of to tackle sustainability reporting, especially as it becomes more mainstream? And then translate the experience and learning of others. And for that, we have wonderful panelists that are joining us today to share some of their sort of practical examples and research and other work. And so understanding that and translating this for your own work. So we'll also be asking a few questions along the way by way of the Zoom poll. And so do please participate in those to help you with your CPD. What I'm going to do is really just run through a very brief overview of the current reporting landscape. And then I'm going to invite our three speakers to, come in and share some of their perspectives. So we all know that, business performance has historically been measured in financial terms. And we've seen a lot of changes over the past 2 decades in terms of the reporting and what the expectations are from various stakeholders. So, we've got a lot more awareness around environmental and social issues that are really coming to life in terms of the impacts we're seeing. And therefore, we're seeing stakeholders really demanding sort of more information around these risks and how they're being managed. And I think we're seeing, where we see the different standards emerging, quite a big global trend towards mandatory sustainability reporting. So this is not just a nice to have off the side of your table. It's becoming something that's critical and almost moving into an enforced state in various jurisdictions. And then, the complexity here is that we're seeing more than 600 sustainability reporting requirements across 84 countries, 25 exchanges. So really a lot going on in the space, making it difficult, to know exactly what's best for your organization, what should be driving your reporting. And we see a lot of drive as well coming from listing rules on the various stock exchanges. So I have a South African history, so we have the listing requirements around integrated reporting, for example, and that certainly is a key driver for getting companies up to speed on that sort of reporting. Although reporting doesn't always mean performance, but obviously it's one place to start. So we see that, where does the finance professional fit into this picture? So we see a lot of organizations really looking towards the finance professional who have a lot of experience and sight over an organization in terms of corporate reporting, broader corporate reporting. Really it's around finance professionals being quite well positioned to help with the reporting and moving to sustainability reporting. So what we're going to do now is just go through the sort of key reporting frameworks we see in the sustainability space, not all 600, of course, focusing on the global ones, and then just touching on some of the regional developments, which are also quite important because I think they're influencing each other in terms of their development. So we have the GRI that's been around for the longest, as most of you probably would know. and they have a set of standards. And really it's around giving a framework for reporting on economic, environmental, society impacts, and then communicating both positive and negative impact on sustainable development that an organization has. So it gives the organization a framework really to prepare a sustainability report. It does have a materiality lens, so you expect it to focus on material topics, and it's also intended for a multi-stakeholder audience, so broader than just your investor or your primary provider of capital. It's broader than that, all your stakeholders that are affected by your business. We then have the TCFD, which most of you said, which was the majority framework where you've been involved with or aware of. This was an idea sparked by an event actually organized by A4S and attended by His Majesty the King in his previous role as Prince of Wales, as well as Mark Carney, the former governor of the Bank of England. So essentially what the idea was that the TCFD was set up, this was in 2015, to develop recommendations for organizations to disclose information about their exposure to climate-related risk. So it has a climate focus. And as I said, these disclosures have really received a lot of support and good uptake, largely through, like I said, I think the link to the financial disclosures makes it easier to grasp and implement. And a lot of support through a market-led approach to development and adoption thereof. So we see a lot of movement in the space, a lot of mandating of the TCFD recommendations by regulators and governments across different countries. And we even see, like I mentioned, the framework is quite strong. So the sort of approach has also been adopted by the International Sustainability Standards Board in terms of how they're putting out their standards, which we'll cover in just a moment. We also have the World Economic Forum. What they did is, together with the Big Four accounting firms, they've published a set of common metrics and disclosures with the support from members of the WEF's International Business Council. So not just an accounting firm issue, they did have business involved. And really what it does is it provides this sort of common set of metrics to help companies report in a consistent and I guess more comparable way as a result on their different dimensions of how they're creating sustainable value. So a key way of achieving these goals, the recommendations don't ignore the existing standards. They definitely do promote the use of existing standards by way of these metrics, particularly with reference to the GRI and the TCFD, which we've just talked about, as well as SASB. So SASB is also sort of sector-specific sustainability standards that are also being used to underpin the International Sustainability Standards Board's work. So it wasn't starting from scratch, it was really drawing on these existing things. And so taking these standards as a starting point, the recommendations of the World Economic Forum proposes then the adoption of a common core of a set of metrics for companies to adopt. And as I said, promoting consistency and comparability. So we also have the SDGs, the sustainability or the Sustainable Development Goals. And they really provided also a framework working towards, 2030 goals. And again, give companies a framework to enable more standardized reporting and transparency on issues such as climate change, social issues, and other environmental impacts. So it's again aligned to the three most influential and popular reporting frameworks, namely the GRI, the TCFD, as well as the IIRC. So that is the integrated reporting framework. That council has been absorbed into IFRS, but it's the integrated reporting framework, again, that was aligned to the SDG recommendations. Then building off the back of the TCFD, we have the TNFD, quite a lot of acronyms here, the TIFD and the TSFD. So really nature-related, inequality-related, and then social-related financial disclosures. So very similar to the TCFD, again, providing a framework for really risk management and disclosure, as opposed to really a reporting standard, and enabling companies to get their head around those risks and be able to report on those in accordance with the framework that's provided. So a lot of development in that space. The TNFD is probably furthest ahead. They're expected to publish a final framework in September. They already have a draft of that out, while the TIFD and the TSFD continue to work on creating the framework in those areas. So I think that's a good space to watch in terms of what they put out. So these are, what I've talked about a lot is voluntary frameworks, I guess. In the world of sustainability reporting, a lot of this is voluntary, but companies choose to adopt this, I think, to be aligned with their peers and also to help them manage risk and communicate with their stakeholders. But what we have seen over the last 18 months is a real rapid acceleration in terms of the development of a global baseline of sustainability reporting standards. And this has been done under the IFRS Foundation. So the International Sustainability Standards Board was formulated in November 2021, and they sort of came together on the back of the merger of SASB, which I've alluded to, Sustainability Accounting Standards Board, the IIRC, so the International Integrated Reporting Council, and the Climate Disclosure Standards Board. So these organizations, in the spirit of coming together to sort of consolidate the myriad of frameworks working towards this global baseline. So what we have is we've got the ISSB, which have now put together 2 reporting standards, one on a general sort of baseline and framework for sustainability reporting, and one on climate requirements. So these have gone through extensive consultation. I mean, I think they received about 1,500 comments from the public, so quite a lot of engagement and interest on these. And these are now expected to be released as final standards by June of this year, so right around the corner, and then need to be adopted by the reporting year 2024. There are some reliefs that you can look into, but I'm not going to go into all that detail at the moment. So the other thing just to mention on the ISSB, I think a lot of concern came up around why climate. There are other issues in the sustainability space. We've got a lot of climate, but I think their philosophy has been climate first, but not climate only. So they definitely have intention to build on that. So they've put out an agenda, by they I mean the ISSB has put out an agenda priority consultation. So they're proposing that they would look at the areas of biodiversity, human rights, and human capital, as well as connectivity of reporting. So the sort of concept of integrated reporting as their next builds onto this global baseline set of standards. So definitely going to broaden that perspective. So that's actually open for comment now. So if you have an interest in that, and I think we'll hear a bit more about that from our speakers, please do look out for that. But I think, the success will rely heavily on global adoption by individual countries and jurisdictions, because they each have their own requirements. So I think, we'll need to see how this lands when the implementation date gets set into action. So I think I'm going to just wrap up the landscape. I mean, the regional things that you might have heard is we've got the EU with the Corporate Sustainability Reporting Directive, and that's come out now as well, and that's going to affect around 50,000 companies in EU, where they also need to produce detailed information on certain sustainability matters. We also have the US, so the SEC there has proposed a rule last year, which should again require publicly traded companies to disclose climate-related risk and greenhouse gas information. That hasn't been finalized though. They were expecting a finalization in April, but it looks like we'll only see the outcome of that later on in this year. So I think you can get a sense for a lot of things going on, a lot of work ahead of us all in our different capacities. And I think big questions remain around, how do we really harmonize these different reporting standards? How do we make the different frameworks work together, and the connectivity with financial reporting? So a lot lies ahead. But what I'd like to do now, before we look at the corporate side and how they're grappling with all of this, is to invite Vania, the chair of the CBARI, the Brazilian Network for Integrated Reporting, just to reflect on what I've just said in terms of where sustainability reporting might or should go next. So thank you, Vania, for joining us today. And I know you've been involved with A4S's work and corporate reporting for many years, so you've seen this evolution unfold in front of you. So I think to kick us off, could you share your reflections on, where you think sustainability reporting is going to, how it's been moving and where it's going to?
My pleasure. Thank you for having me here, Yvette. It's a great honor to be here sharing with you my experience regarding sustainability reporting, because I'm an accountant and I love accountancy. And a million times I was to choose my profession, I again would elect accountancy. It's fascinating, in my opinion, to reflect business in a standardized way, so everyone can understand what happens, what were the risks, the performance, and so forth. So until a few decades ago, every country had their own accountancy policy and standards and regulators. And so we were not able to compare a company outside the country unless you converted the financial statements to the standard that were used in a different country. That was a mess in a globalized way. So the question is that we did not make business just within our boundaries anymore. So in a certain point of time, it was decided that we will convert the accountancy standards into a global basis. So we will be able to compare, you'll be able to provide useful information for stakeholders to make decisions. And IFRS was elected as this global-based standard for accountancy. That was the time I became involved with international regulation, because I was head accountant for the Brazilian Development Bank, a state-owned bank in Brazil that had the monopoly of financing long-term financing in Brazil. And the Securities and Exchange Commission in Brazil and the central bank asked my help in order to try to anticipate which difficulties Brazilian companies will face if we were to adopt international standard for accountancy. That's when I became following IFRS Foundation, and then I became involved also with IAASB, that deals with the standard for auditing and assurance, and became involved with best practice in corporate governance as well. And finally, with the IESBA, which is the Ethical Standard Board for Accountancy. So I was pretty much involved with international regulators, and thank God, Brazilian adoption of accounting standards in a global basis was a huge success. But for my surprise, in the eve of Rio Plus 20, His Majesty sent a delegation for Brazil to speak with the CEO of my bank and asking BNDES support in order to advocate for sustainability reporting as well. And then my CEO called me and told me, you are already in charge of international regulations for market transparency. Now you can take care of that as well. And then I told my CEO, but I'm an accountant. I know nothing about sustainability. This is not my expertise. I don't think I can contribute. But he asked me, he answered me that I was a specialist in transparency, and he could not conceive total transparency without the sustainability side. And I think that it was the best advice I ever received during my whole career. I've been involved with integrated reporting since then, since 2012. And I cannot no longer conceive my profession without looking at sustainability aspects, because I understand that if my profession mission is to provide useful information for those who must make decisions, if I just show the financial development, I'm not really providing useful information for the market. Because a company that is extremely profitable, if they do not take care of ESG aspects, they, for example, can be very profitable, but they use some natural resources that are limited. And once they are depleted, there will be no longer a business to provide sustainable profitability for investors. If they are profitable, but they do not respect human rights, they will not be able to acquire new talents in the market. They will not be able to attract innovation, and they will lose their employees to those who have better conditions, working conditions in the market. So they will no longer be able to deliver profitability in the long term. And the same for corporate governance. If they are not sustainable, if the price they pay for good contracts is bribery, it's corruption, that will come to the light someday, and they will lose contracts, and they will lose business opportunities, and they will no longer be able to deliver profitability. So if a company wants to be sustainable, which is to be able to deliver value generation in the long-term basis, then they need to look at the economic side, but also to the ESG side. So it's something that changed my way of looking at my profession. And it's an honor for me to be able to contribute to integrated reporting, and now within IFRS Foundation, to keep on providing transparency in my country.
Thanks, Vania. And I think you've talked about the different sides of the reporting, financial sustainability, and then this concept of integrated reporting. So I know with a lot of experience behind you in this space, what are your views in terms of the role that, integrated reporting and the framework can play in terms of this connectivity with financial reporting? Because that seems to be, in the spotlight.
That I understand that the best way to report sustainability, and many people think that sustainability is the same thing as ESG. No, sustainability reporting is when you are able to report financial, environmental, corporate governance and social in the same level of quality. We already have standards for accountancy for many years, but in sustainability, in the sense of ESG, we are just beginning. And that's why I think my profession is so important in this process, because we can help to accelerate, to fast the pace of providing transparency in this sense. But we know that the model of reporting ESG on a report or explain basis is very difficult, because we have fragmentation of frameworks in the market. And so everyone pick the one that will show them better in the photograph. And as a result of that, we lack comparability, we lack consistency, and we lack the possibility of anticipating risk and use that to manage the opportunities of business. So I understand that the best way to avoid that is to link ESG information to the financial one, which is exactly the proposal, what integrated reporting recommends. That will avoid greenwashing, that will facilitate assurance, and that will make the sustainability information be presented in a language that financial people are able to understand and to use this knowledge in order to make decisions. So I think that it is very fortunate that IFRS Foundation was the one to incorporate integrated reporting and to be the one to establish standards for sustainability reporting right now. I think it's this connectivity between financial and what the so-called non-financial aspects are essential for us to have a useful information, not only for outside stakeholders. I think that the first to benefit from that should be the management of the company itself, because they will have better conditions to make decisions and evaluate and assess risk before making a decision about a possible investment option.
Sure, thanks, Vania. And I think thank you so much for those insights, and especially sharing with us that advice you got. I think it's going to be useful for lots of other people to say, why me, or how can I as a finance professional and accountant get involved here? But I think you proved that you've got the right sort of mindset and approach to think differently and have an impact in this space. So I really appreciate those insights. I might come back to you and ask you just something about the ethics point. But for now, I'm going to ask if we can bring Kelly on board and ask her. So just to introduce and welcome you, Kelly. Kelly's an ESG specialist and stakeholder manager at the UCLA and Anderson School of Management. And I think, we've heard a lot now about standard setters and the frameworks and all that behind that. And lots needs to be done. But you've been working on this Open for Good project, and you've had a look at the Americas companies in terms of their public disclosures across these areas. So I'd like to hand over to you and ask you to go through some of your findings in this space in your context. Thanks, Kelly.
Great. Thank you so much. Let me just share my screen briefly. So thank you everybody for being here. My name is Kelly Clark, and I am at UCLA Anderson, the Business School's Center for Impact. And a few years ago, we started seeing all of the problems we've been discussing. When we look at the data that's out there in the sustainability landscape, it's really difficult for stakeholders to use the existing information. And so we started the Open for Good project in order to provide transparent, unbiased, and accessible insights into sustainability performance. So as we talked about a little bit already, disclosures remain almost entirely voluntary in the US, and our research is focused on US companies. Even when companies do disclose the same things, we're seeing them disclosed in different ways, which makes them really hard to compare performance. When we look at ESG rating agencies, and we haven't really discussed those much today, but these are companies who provide scores on either an overall score or on the independent pillars of E, S, and G. We see that those ratings can vary substantially between rating agencies for the same firm. And so what this all kind of leads to is a lot of information out there, but it's not presented in a way that we can really use. So what we did is we took the World Economic Forum's metrics, one of the frameworks we talked about, and we decided to look at what firms were actually reporting in the public space according to these metrics. We actually reduced the set of metrics down because there were a lot of them out there. And we focused on these main metrics within each pillar. And World Economic Forum, as we mentioned, has the benefit is that it incorporates metrics from GRI and from SASB. And so we were hoping that we could see on the most common metrics, what are we seeing out there in the landscape? So on the environmental side, we looked at carbon emissions. We looked at all of the subdivisions of the Task Force on Climate-Related Financial Disclosures, and I got that acronym backwards on there. Oh no, I didn't, TCFD. We looked at land use in terms of are companies reporting that they have sites near key biodiversity areas? And we looked at water use. Are companies reporting their water consumption and withdrawal? And are they reporting how much of that water comes from water-stressed areas? On the social side, we looked at employee diversity, compensation practices, particularly regarding gender differences in pay, risks of forced labor, and access to healthcare, which, although may not be as much of an issue in countries outside of the US, is an important issue for US companies where we do not have universal healthcare. On the governance side, we looked a lot at the makeup of the board of directors. What competencies did they possess? What diversity do they have? How much experience? Are they independent? And so we use this as our first proxy of what we should be looking at in sustainability. Our sample set is the S&P 500. We collected 1 year of public data. So all of the information we have here is publicly available. Anyone can gather the same thing we did. The trouble is it takes a lot of time to do it. We do this collection manually with students. It took us about 2 years to get the first set, but we've worked and we're working to automate more of it. And our total, those metric categories I mentioned earlier, break down into 39 separate submetrics. And from this, we collected 2 principal pieces of information. We looked at, are firms disclosing this information? And if they are, what are they actually disclosing about it? So using the first bit of information, we formed our 2023 Transparency Index, which is really just looking at how much firms are disclosing on these metrics. And from this, we realized we had this great collection of data, but it wasn't easily accessible. It was in a big Excel spreadsheet, not something everyone can use. So we developed a website with an interactive dashboard on it. And you can see this if you look up UCLA Anderson Open for Good. This will come up. And what we can do here is, we've talked a lot about E, S, and G as kind of a monolithic thing. They're all usually reported together, but in reality, sustainability is so value driven. What makes a company sustainable depends on what you value in that. And so if you value the environment and that's the most important thing to you, we created a way for you to kind of see how companies are disclosing according to your own values. So these sliders up at the top here, these are movable on the website. And so if you put environment to the max and put social and governance to the minimum, what you'd end up seeing is a ranking of how transparent companies are according to the environmental metrics. And you can do the same thing with each of those, but this allows stakeholders more insight and control into what they value and what they see as important and how companies are performing according to those values. We also created a way for you to look at different sectors, because that's a key thing when we see reporting. We talk about a lot of different frameworks here, but inherently different sectors have different impacts on the world around them. And so while environmental disclosures are really key for our utilities sector, that sector has been heavily regulated for years. So they are really good at disclosing this information already. We also can see the social pillar. We see consumer staples is again in the top performers on that. And if we look at governance, we see real estate as our top performer. So all of this data is available for stakeholders to play with on our website. But getting back into, for more practitioners, if you were looking at what to do in sustainability and how to kind of take the lead, this is our first kind of interesting statistic here. If we look at the average disclosure rate by topic, we see governance is leading. 60% of the, on average, firms disclose 60% of the governance metrics. Environment, we're down to 43%, and social, we're at 50%, which means if you were thinking of how do I make my company more sustainable? How do I improve my disclosure in the eyes of a public stakeholder? Focusing on the environment and the social pillar are ways to help distinguish your performance in the marketplace. It also underscores the importance of looking at these pillars independently. Many of the governance regulations are things that companies have been required to report for years, so their performance on them is naturally higher and kind of buoys up the performance we see on the environment and on the social disclosures. So this year's, if we're looking at the top performing companies, this is our list of the top 10 companies who disclose more of the metrics that we were looking at. And as mentioned earlier, I definitely want to iterate that disclosure is not equal to performance. We believe it is a very important key first step to improving performance, but the company that disclosed the most information may not be the most sustainable company out there. Also, when we are looking at firm disclosures, one really important thing to keep in mind is that unlike financial disclosures right now, there are no audit requirements essentially. In the US, large public filers are required, or all public filers are required to provide some level of assurance of their financial disclosures to the SEC. When we look at what's happening to the ESG disclosures, we see very different, a different picture. We looked at whether a firm mentions in their sustainability report that they have an external body fully assess their entire report, whether they look at certain aspects of it, for example, their carbon emissions or their water, the most common ones, or whether they don't make any mention of it. And so what we're seeing here is more than 60% of firms don't mention any external assurance of the data that they're reporting, which as a stakeholder is very concerning, because if you're reporting great numbers, but we don't know how trustworthy they are, it's unclear what you're actually doing in that space to us. So for people starting out in reporting, I think it's really important to, at least for the quantitative, more easily assessed numbers like your GHG and your water, to start figuring out how you can bring in some level of external assurance on that front. And now I'm going to give you a brief preview of our performance information. So we will be putting out our next State of Corporate Sustainability report in the fall, where we delve into the performance as opposed to the disclosure side of things. So what we see in performance is, it's a mixed bag. We have some sectors, if we look at, for example, the percentage of women employees by sector, we have healthcare in the US, which is doing more than parity. But then we have some sectors that are very heavily dominated by men. So materials, energy, utilities. And these paint an interesting picture of kind of how the workforce is segmented in the US. What I like most about this is that this is average employees. If we then move to the board of directors, we actually see a much bleaker picture. Even in healthcare, the industry that had more than 50% of women employees, if we look at the people on the board, we see they're only at 30% of them. There's also a very narrow spread between the highest and the lowest performing industries here. Really 25% is the minimum, 32% is the maximum. And so what this tells us is there's still a long way to go in diversity when we're looking at board characteristics. This is an interesting one. This one is required in the US that companies report the total compensation of the CEO compared to the total compensation of the median employee. And it kind of shows a proxy of how much value or how much the resource allocation between employees and management there. And so if we look at these, we see a vast discrepancy in what CEOs are being compensated with compared to their employees. And then finally, the last one I want to talk about is our greenhouse gas emissions and the environmental side. We've reduced this to kilograms per dollar of revenue. We've normalized it because emissions vary greatly, sometimes depending on the size of the company. But it's a measure essentially of what your impact is versus your revenue here. And so these are some of the top emitters and what we're seeing within the utility sector, which is initially a heavily emitting sector as we there. As we move on with the Open for Good project, we're looking to issue our report with performance information as well as the disclosure. And we're looking to develop this longitudinal tracking of data, because right now there's a lot of piecemeal data out there, and we are looking to kind of start tracking performance over time based on firm public disclosures. And we're ultimately working to expand our metrics too, because as we discussed, we have more than 600 potential ways firms are evaluated. We're looking at 39 of them. And that's kind of a question that goes into then, how do we find metrics that are applicable to all firms versus ones that are really kind of only material for a certain number of them? So thank you so much for your time, and happy to answer any questions you have about this.
Yeah, thank you, Kelly. Yeah, I certainly found that fascinating, and I really liked your perspective on how values of those looking at your information drive, what's important to them and what they're looking for in your information. So I like that perspective, but thanks so much for sharing that with us today. And we're going to round up with the sort of perspective from the corporate reporter themselves. So we have to welcome Johanna Recoura from the Schneider Electric, who's the VP of Sustainability Reporting and Group Accounting, and a member of our A4 SDFO Leadership Network. And I think that the big ticket items that we would like to hear from you is really around, let's start with your approach to sustainability reporting, and how the finance team plays a role in that. And I think perhaps reflecting on how you use materiality to drive that approach. Thanks, Jan, and welcome.
Thank you, Yvette. And first of all, thank you for inviting me to share Schneider's perspective in this webinar, and hello to everyone around the call. So maybe to start, and just as a background, Schneider has been an early adopter of ESG matters as a key topic for the company. Indeed, in 2005, so almost 20 years ago now, we published our first impact barometer and what we now call, you may have heard, Sustainability Impact Index for SSI, which is updated every 3 to 5 years. So most recently, we have launched our 2021-2025 SSI with ambitious targets. And effectively, it's a set of goals we follow as a key part of our company strategy tied to the UN development goals. And importantly, those goals are not just corporate social responsibility oriented, but intended to drive good business over the short, medium, and long term. So to answer your question, maybe more specifically, in conformity with regulation in place and in the spirit of transparency, of course, with our stakeholders, we regularly publishes corporate social responsibility data, which includes notably, and maybe I will focus on that. So first, indicators of what we call SSI, which is published quarterly with the same importance than revenue publication. And this is the only thing that we publish at the same pattern, and externally assured also annually. Second, indicators that we call SSE for Schneider Sustainability Essentials, also published and insured annually, okay? And other standards, HR, safety, and environmental indicators, published and externally assured annually also for the most material ones. When it comes to what is the roles that finance plays, as a company, really, finance is looking to drive both financial and ESG results together and in an additive manner to each other. So it means not only do we need to ensure the correct reporting of our ESG ambition, but also to shift our performance model. And finance plays a key role in driving the convergence of financial and ESG results, as we really believe this drives long-term value for our company. And our CFO, Hilary Maxson, strongly embodies this vision and actively discuss ESG in her interviews, articles over the past years. She also represents Schneider in key association or organizations such as yours, or also the UNCG CFO Coalition for the SDGs. On top of that, investor relation team, which is part of finance, oversees communicating what we call our integrated thinking through quarterly presentation, and they organize also specific ESG events. Another thing is through our treasury team. The group decided to link the cost of its debts to the performance of our SSI. So it's where we really linked financial instruments with ESG metrics, and targets were reached in 2022, allowing a 2 BP decrease in the margin of our banking facilities. It's just an example. Last, maybe to mention, a sustainability finance VP position, my role, but it's the first role in finance, has been created really to boss ensure correct reporting of our ESG ambition and also shifting our performance model, as I said, to embed our ESG strategy in our planning process. And finance drives the setup of ESG CapEx tracking in our investment tool, for instance, but also the measurement of carbon footprint reduction as a key decision criteria in our R&D investments. And last, we co-lead with my team CSRD project, ESRS, and EU taxonomy in a strong collaboration with sustainability. And maybe if I move to, because you asked to materiality and how we do that. So every year, Schneider Electric perform risk, opportunity, and impact assessment, considering issues that can have direct positive or negative financial impact for the company in the short, medium, and long term. So in other words, a financial materiality perspective here, but also impacts the company may have on people or the planet directly or indirectly in its value chain. So here more on an impact materiality perspective. So the assessments rely on a panel of both internal and external tools, take into account stakeholders' expectation, and they are coordinated by different teams in Schneider. So particularly strategy and sustainability team, group risk management function, and duty of vigilance committee play a key role in this area. And other topic-specific committees exist, and they oversee the group strategy in those issues, such as the carbon committee, HR committee, on ethics committee. So if I summarize, key internal tools here are first, an internal and external stakeholder consultation that we call materiality assessment, group risk matrix, vigilance risk matrix, and other specific risk matrix. And maybe just a word about how the new regulation will change this approach coming to CSRD and ESRS. So as I said, we already have something strong, as I explained, with this kind of already double materiality approach, but we want to implement some evolution. So we need first to articulate together the different internal tools I just described to ensure we address the ESRS teams in this exercise, to align the different process calendars in order to build a consistent, documented, and auditable approach for the purpose of complying with CSRD. And maybe more specifically, we need to adapt the way we consult our stakeholders to be more topic specific with them and less generic as we are today. So we are launching the project and with all the teams involved around the table with the expectation of finalizing that in 2020, are organizing specific working groups by the end of the year.
So I think it sounds wonderful, very integrated in terms of the way you've structured and working. And that's, I think, what we all need to strive for as organizations. But just to round up the sort of discussion we've had today on reporting, one can't really talk about reporting without assurance. And I think Kelly started talking about that. So what are you doing in terms of assuring, giving credibility to all the sustainability information? And again, how is your team sort of set up to be involved in that process?
So really, maybe I can start saying that in the French transposition, because I don't know if it's clear for everyone, but in the French transposition of the NFRD, we already have this compulsory audit by an external party with the aim of obtaining a moderate assurance, okay? So therefore, once a year, an external auditor reviews the procedure in place and data accuracy in order to provide limited assurance on extra financial information as required by the French Commercial Code, notably on our SSI, SSE, and other specific indicators, as I just said before. It's this external assurance practice, it's in place since 2006, so it's not new. And in keeping with our commitment to really continuously improve, we ask this year PwC Audit to conduct an additional review in order to obtain a reasonable level of assurance for strategic indicators. So not on the full scope, but on energy consumption, on scope 1 and 2 CO2 emission, on safety, and on gender diversity. So they really raise their level of audit. And so we gain more assurance on those really aspects. So we can say that this is a first important step towards the regulators' expectation. And we know that, of course, there are many challenges when we start to step up the level of insurance in the same direction than the assurance of financial statements. Okay, because just to say, despite being one of the leaders in sustainability reporting for quite some time, there is still a clear gap in terms of maturity between financial reporting and ESG reporting, whether in data, digitization, automation, internal control, which is really important, or just simple auditability. And when we discuss with the auditors, it's much less easy for them than for financial reporting. I'm just maybe mindful of the time, so just concluding here on the question.
Thank you very much. Yeah, so I think just to build on to that, the IAASB is also looking at a standard that will hopefully also provide some tools to sort of further the assurance processes in this space with the different requirements coming up. But yeah, I mean, we've really been fortunate to hear from all three of you today. So thank you again to Vania, Kelly, and yourself, Johanna. I think we can all get a sense for a lot going on. We all get a sense for a lot of challenges to still overcome as we make our way and navigate our way through this. I did note a question around, well, where do we go to find out and keep track of all these developments? There are a lot of places, but the A4S does have a navigating the reporting landscape document, which we'll update shortly. So I think that's perhaps a good place to start. And then, now I guess you've heard a lot of things going on, how these our panelists have kindly shared how they're approaching the challenges. So what are you going to do? Where are you going to take your learnings and work in the next 6 months? So I see a lot of it is starting at the basic level of improving understanding of what these requirements actually are. I think that's a good starting point. But don't feel like you're too far behind. This is very fresh, very new. A lot is still emerging. So I think it's going to take time to understand and implement. And remember, reporting frameworks it's not just about compliance. It's about making a positive change and managing your risk and communicating with your stakeholders. So I think that's a great action and a great place to start. So thank you all for joining us today. We will have a follow-up email where we will be sharing with you some further resources in this space. And I think just as a last point, you know, we run these webinars fairly regularly, and we're always keen to get your feedback on how they're going. So we're just closing off with a poll on that. But just a final thank you again to our speakers. I've certainly enjoyed the content that they've shared with us, and for all of you for joining us today. Yeah, so thank you, and we hope to see you again on our future webinars.